Hi there, and welcome to this presentation from MPC Markets on the alternative assets class. Today we're presenting a structured investment. Get paid for patience is what we've titled it. It is an ASX diversified smart entry note. Has the reference assets of Wesfarmers, Macquarie Bank, Commonwealth Bank, and Xero, four very popular and high-performing stocks on the ASX. And the reason we've pulled this custom investment together is we've had so many investors ask us recently, should it be taking profits at these levels and buy back lower? So we partnered up with StroPro, our structured products provider, and we pulled together a structured investment that actually pays you 8.5%, and then also sets you a re-entry price 20% lower in the event that those stocks get down there. So you get the best of both worlds with those. Just a quick disclaimer: wholesale and professional or sophisticated investors are only eligible for this for these investments. We can't do these investments for retail investors, unfortunately. General advice warning: the content in this webinar is general in nature. It's for informational purposes, and it does not take into account your personal objectives, financial situation, or specific needs. Past performance is not a reliable indicator of future performance or future results, and best efforts have been made to ensure the accuracy of the information within this webinar. So why would you use a smart entry note? So, these are pretty new concepts for Australian investors, but basically the smart entry note, if you're an investor who's coming in with cash, or you've sold a house or something and you're a little bit cautious about entering the stock market at today's prices, or you're sort of getting towards pension phase and worry about the downside risk, this would very much suit you, because obviously you're getting a really nice dividend yield at 8.5%, and you're obviously mitigating or at least 20% downside risk on these really popular ASX stocks. Also, this would be very suitable for someone who either owns Wesfarmers, CBA, Macquarie, and Xero, or any combination of, where they would like to take profits in their stock, and where we've obviously just had earnings season. Dividends have now been paid, and they want to continue to receive a nice yield after being paid their dividends, and re-enter those particular ASX favourites at a 20% discount to current prices. So structured investments, and particularly these smart entry notes or discount entry notes, they're very good tools for investors wanting to reduce their risk and maintain their portfolio income. So we deal with the lion's share of our clients being heading towards pension phase or in pension phase. It's a really good recipe for those types of investors to, as I say, reduce that downside risk and get some squeeze some extra yield out, which is increasingly becoming hard to get out there at the moment. With some of these stocks at super high prices, they're only yielding on average around that 2.94% mark. So a little bit about myself. I'm the founder of MPC Markets and CEO, head of equities. I started in the mid-90s on the futures trading floor. 20 years plus of my career was as a professional trader. So I've experienced multiple, economic and investment cycles, multiple black swan events. I'm pretty macro focused, and as an investment philosophy, and I really do focus on not only helping clients build wealth in the good times, but there is a really heavy focus on protecting our clients' portfolios during these these downside periods where the market's a little bit expensive. And obviously partnering up with the likes of StroPro for these structured investments in these smart entry notes and discount entry notes, etc., and fixed coupons notes, it really does bring that institutional grade end of town optionality to your everyday investors' portfolios. So reasons you do use structured investments. So look, use the tools that the professionals use. This is a quote from BlackRock, the world's largest investment house. I think they were managing somewhere north of $6 trillion a couple of years ago even. And their quote is, adding 20% allocation of alternatives to a traditional 60-40 portfolio increased the annualized returns by up to 10% over a 10-year period, while simultaneously reducing the portfolio volatility by 10%. So who doesn't want that, right? Where you basically increase your returns but reduce the volatility and the risk in your portfolio. It's a great combination for basically every investor. Morningstar, which is the global research powerhouse, they've also got a quote here: during market downturns, portfolios with alternatives experienced smaller losses compared to a pure 60-40 portfolio. So as you can see on the side there, at the moment, holding the stocks that we've got as the reference stocks, those 4 stocks, is around about a 2.94% yield per annum. That's including franking credits, so I am being generous here. Versus the smart entry note at 8.5%. It's about 2.9 times more yield. Holding the stock obviously has downside risk. We'll get to what the average downside risk is for rate cut cycles and economic cycle turns in a moment. But obviously, with the smart entry note, you're mitigating that initial 20% from the first day of investment, and entering those stocks at 20% lower prices. So this particular custom investment or structured investment, get paid for patience. We've named it ASX Diversified Smart Entry Note. The term's 12 months. There's rolling every 3 months to give people optionality to either execute the trade or continue receiving the coupon. The smart entry is 20% lower from the price, the reference price on the day of investment. Or the day the deal closes. The coupon rate's 8.5%. That is subject to change in both directions, but it won't generally be much more than 20 odd basis points either way, I wouldn't have thought. Coupon frequency is you get paid monthly. So for those searching for income who have just received all their ASX dividends from earnings season, selling out of some of your Wesfarmers, your CBA, your Macquarie, etc., and then going on to these monthly payments, which are 3 times higher than what you've been receiving, is a fantastic option for those who want some income. So obviously the reference assets: Commonwealth Bank, Macquarie, Xero, and Wesfarmers. So across the financials, the tech sector, and the consumer discretionary sector, they're all fairly cyclical. So obviously the rationale behind this is, well, firstly, our desire to create this smart entry note was the continual questioning on whether that people should be taking profits, both on Ausbiz and Livewire, etc., where I regularly publish or appear, but also overwhelmingly from our clients. So the rationale behind this is we think the cycle's turning. We'll get to that in a minute, but there's some reliable indicators showing that the US economy is about to turn. The actual performance of stocks during a rate cut cycle, many would be possibly quite confused as to the investors rejoicing rate cuts this year, but it's in fact the reverse. It's not a good thing for equity markets, in the initial part. Second rationale is the stocks we've chosen are historically expensive on a 5-year basis, and they are particularly cyclical as well. And the third one is, leading into September, we do have seasonal weakness in the US. September-October periods are traditionally, or on a statistical basis, the 2 weakest months on average, over the last sort of 50-odd years. So just to explain the economic cycle, as you can see there, half to 2024, we're in the slowdown period there, as indicated by the green box. And the economy is starting to slow, particularly more so China and the US globally. Australia's always seems to lag about at least 6 to 9 months. Probably expecting in the US, particularly as well, and obviously, as we well know, I keep quoting the statistics from the US, but the US is big brother. And look, if they sneeze, the world catches a cold. So realistically, it's much more reliable to be using the stats from the US markets, because they are the biggest market in the world. So we're expecting, potential recession coming into 2025. There's 3 really reliable indicators of this. The SARM rule, which is related to the increase in unemployment and the unemployment rate in the US from the bottom of the levels of the unemployment rate. This this particular rule, since 1970, has 100% reliability in picking the onset of a recession about 3 months in advance. So, 100%, you can't get much better than that. The yield curve being inverted, so that when the yield curve is inverted, it means that short-term rates are higher than long-term rates. Traditionally, within 3 months of that, of the short-term rates actually going back lower than the long-term rates, I think it ran about an 80% rate since sort of the 70s or 80s. It's predicted a recession. It's not 100% reliable like the SARM rule, but it's still very high up there. And also, manufacturing purchasing managers index, which is purchasing managers data, in the manufacturing industry. Whenever it's reached 45, I think it's been very close to 100% predicting a recession. We've had, neutral is 50 in this number. So above 50 is expansionary, below 50 is contractionary. We've had 16 or 17 contractionary numbers in a row, which didn't even happen leading into the GFC. I think it's been 25 years since we've seen that consistent weakness in the US manufacturing industry. So they're obviously, we're not just saying a recession's coming. These are three highly reliable indicators that we are looking at some sort of form of downturn coming up. And we're lucky enough at the moment to be very close to record highs, because you would rather be taking your profits now than obviously getting caught in that downside risk. So with rate cut cycles, the average drawdown, so just using the financials as an example here at the bottom, the last three drawdowns over rate cut cycles have been roughly around about that 20% on average. As you can see, they're lined up there. This is where we tend to get rate cuts and slowdown cycles. So very similar statistics in the consumer discretionary and technology sectors, slightly different reasons. Consumer discretionary being highly cyclical, the banks being cyclical, particularly in Australia, because obviously they're effectively mortgage brokers these days. And the technology sector mainly due to the fact that they're very high growth, high PE, and if the economy's not growing, you've got to be an extraordinary company to be justifying those high PEs. So as a general rule, we do see those sectors draw down around about that, anywhere from say 25 to 18% on average, depending on what the rationale is. I'm not necessarily saying we're going to go that deep, or there's a black swan event coming, or there's Armageddon. I'm merely just saying these are the historical averages. So that's why we picked around that 20% mark for the average drawdown, because the intention is very much to get back into these high quality, long-term wealth winners in Wesfarmers, CBA, Macquarie, and Xero. So these stocks at the moment, however, obviously the last year, the XJO has been up around about 9%. This is at the time of producing these slides, etc., and recording. CBA and Macquarie up around 23, 24, Xero up 36, Wesfarmers up 39. And what I'm going to reference you to here is the two columns we've got where the average price to earnings ratio range over the last 5-year period. So the range has been 12 to 35, 35 being expensive, of course. Currently, Wesfarmers sits at 32. Xero, the PE being a growth stock's not necessarily applicable in this example, but as you can see, the price earnings ratio is enormous, in triple digits. Macquarie, 8 to 25, currently sitting at 24. CBA, 10 to 25, currently at 25, and seems to be almost making a new record. That is a record high price earnings ratio for CBA. And by their own admission in the last earnings season, we're not expecting any sort of, I think they were expecting a 3% contraction in their earnings. So at the current yield for CBA, which is the lowest I've ever seen it in my time in markets, we're around about that 3, or just below 3%. I think their term deposits actually yield more than their actual stock at the moment. Just moving on to this seasonal weakness now. September is the weakest month for the S&P on average. This applies to the NASDAQ as well, but the S&P is a broader index. And I think more applicable to the stocks that we're talking about as the reference assets. So the monthly return stats since 1964, the in September period is the only month where it's less than 50-50 of the market going up, and on average it usually loses around about 1%. October has the unfortunate title of having the worst month on record, down 22%. But to be brutally honest, that's probably more to do with pressure in that August and September period and a capitulation in October. As you can see in October, there's usually quite a V-shaped recovery as we go into that Christmas, that usual Christmas rally. So this seasonal weakness, that has obviously, over a 50-year time frame, that's a lot of data that's fairly reliable. So the investment comparisons say we are going to go into that downturn. Smart entry note versus holding the stocks. Obviously, in holding the stocks, your current yield 2.9. It's semi-annual. You've just been paid your dividends. You're not looking at another dividend, and you're taking the risk on the economy turning when we get to the next earnings season in February, March next year. Versus a coupon, 8.5% paid monthly. So 2.9 times higher yield than the current stock yield. Holding the stock and taking the risk, the average drawdown, rate cut cycle 18%, economic cycle turn 26%. Obviously, with the smart entry note, you're setting your plan, which is always a good thing to do in advance. The average drawdown obviously is nil up until that 20% mark, and you can enter those stocks 20% lower, which I'm sure nearly everyone agrees is, on a long-term basis, is going to be a pretty good wealth winner in those 4 stocks that we've mentioned. So you can invest with confidence with these structured products. They're obviously OTC products with a counterparty. Our partner StroPro tenders these custom investments out, and they deal with 9 of the world's largest investment banks. You would have heard all of their names. They're all A-rated global investment banks, and there is, the counterparty is highly reliable with those A ratings, and obviously dealing with 9 of those investment banks as well. We ensure that we get you the best deal that we possibly can by putting it out to tender, or StroPro does, on our behalf for you. So we tend to come up with the investment thesis and the investment ideas, and then StroPro, in partnership with us, will go out there and get us the best deal to get you the best deal. Getting started is super easy. You've got to be a sophisticated investor or S708 investor, firstly, and then you need a certificate that obviously verifies that. 2 forms of ID: the directors, self-managed super. We need trust deeds, ABNs, etc. as well. But on a pretty regular basis, we will, it'll be same day setup, and then obviously the next step is you choose your investments. Obviously, this one is the paid for patience. The store of value is another one we're offering at the moment, which is a gold-silver investment, which is more enhanced growth using leverage, which has some tax benefits as well. Jonathan Takadena, one of our senior advisors here, or head of trading here, is going to cover that one in another webinar, which is available on the website as well. But yeah, you choose your investment, it gets confirmed, and particularly in the instance of this paid for patients, the coupons then just get paid directly into your nominated bank account. At the end of the 12-month term, or if you decide to exit early, obviously that just your investment goes back into your nominated bank account as well. Some recent investments we did we had a lot of clients looking for yield in fixed interest. We weren't satisfied with the low yields, so we went and bundled up a REIT's 3-year fixed coupon at 10.1% per annum, paid quarterly. Real estate basket of some well-known REITs in Australia that were already trading at 20% discounts to their net tangible assets. They've all since had earnings and haven't had massive. They've had less than expected write-downs. So that one's has a 20% buffer, but even over the 4 reference assets that we use there, I think only one of them in COVID for a very brief period actually breached that downside barrier. But over a 3-year period, as they say, safe as houses. Another one we had as well was Powering AI, which is copper uranium. It was a little bit leveraged and sharing in the upside. It was much more beneficial than holding the stocks, and it reduced quite a bit of the noise. You obviously received the stock at 24% lower. If we saw a rally of 20% or more in BHP, Cameco for the uranium, or Newmont, which is copper gold, you actually ended up extrapolating even higher returns out of holding that versus holding the stocks. There was also an S&P 500 enhanced growth, 5-to-1 leverage. So, for instance, $20,000 down for $100,000 worth of exposure. Your downside's capped at your initial investment of the $20,000, but as I say, you're obviously only having to put down 1/5 the capital to get that exposure. So it's very capital effective, and there's also some tax benefits in that as well. Our store of value one, the gold and silver, again, 12 months, 10-to-1 leveraged, same deal. Cap downside, $10,000 down for $100,000 exposure. You can't lose more than your initial investment, but you're obviously getting that $100,000 worth of notional exposure. So it's super capital effective and really does leverage that upside for you. That one will close around about the same time as this one, around about the 18th, I believe, of this. Lastly, how to contact us. Obviously, we're in Sydney here at MPC Markets. Telephone number 02 7208 8002. You can email us at invest@mpcmarkets.com.au, or you can obviously go to the website and hit contact us there as well. So if you're interested in investing in these, please, or if you've got any questions about these investments, or further queries, please don't hesitate to call any one of our advisors or myself, and get in contact, because these deals will close in the next couple of weeks. You'll also be able to catch us on Essential Alternatives AusBiz event special in the alternative assets section. I'll be on there with Anto, who is the founder of StroPro. So you can see some of the other products we've got to offer there, and hear an expert explain these structured products. Thank you very much for attending this webinar today, and hopefully we can help you with your investing future.